Welcome to Wise Women Wednesday. Really excited today. We've got Cara Julian, who's the director of a mortgage brokerage called Brava Finance, which is quite fun for us. She has over 10 years' experience in property investing, a degree in commerce, and a diploma in finance and mortgage broking management. She specializes in helping women build financial confidence to conquer the property market and build a financially secure future. Her unwavering mission is to improve financial literacy and help women challenge and disrupt outdated and archaic societal norms around finances. To help support this mission, she has authored a book which she gives away as a free resource, and right now she is working on creating educational programs and workshops to deliver to the local community. Today we're looking at how to invest using equity in one property to buy another. Fascinating. Key benefits of investing in property, what is equity and how does it work, and things to consider when using equity. Over to you, Cara.
Thank you, dear. It's so wonderful to be here today. Um, when thinking about what to present, so many different things. But I thought I would do this one. It's quite a common question as sort of people trying to get their head around understanding how to invest in property using the equity from perhaps their owner occupied property. So this is one of the ones that I actually do a workshop on. So please, reach out if there's any questions you have that you want me to explain during, or we can do that at the end. It's up to you. So basically, there's many different ways to build wealth. Let me just put my timer on. Many different ways to build wealth. Investing in property is one of them. Historically, we've seen property prices increase, and sometimes it's good to use alongside perhaps investing with, in shares for that diversification strategy. According to the ATO, interesting, approximately 1 in 5 Australian households actually own an investment property, which is interesting. But before we start, I think on anything, it's really important to get that support team around you before you start on the journey. Whether that's your accountant, a real estate agent, or buyer's advocate, really working for you as the buyer, a mortgage broker, maybe financial planner, just to be able to understand all of the aspects for the property investing so that you can help make those smart choices. And as a mortgage broker, you have the option of going direct to a bank or using a mortgage broker. Using a mortgage broker, we have access to over 50 different lenders. So really, we can, understand your unique situation and work for you to help you find a lender that is truly within your best interests and customize that strategy that's specific to you and your goals. I liken it to if you want to buy a new outfit and you go to Chadstone Shopping Centre, for argument's sake, if you go direct to a lender, it's like going just to one shop and expecting whatever they have in their store to work for you, as opposed to a personal stylist, who understands your brief, understands all of the niches of each store and can actually take you around and help find an outfit that works best for you. So that's similar to using a mortgage broker. So investing in property, there are many different benefits. I've got just 4 here that I wanted to focus on. Obviously, the capital growth, as I mentioned earlier, historically, Australian property values have increased. If you're thinking about it short term, 1 or 2 years, it's probably not ideal. It's sort of that 10-year sort of plus where you do see that trend of property price increasing. You can get recurring income. So obviously the income comes from the rent that is paid. Sometimes can cover your mortgage, sometimes, which would mean it would be positively geared, sometimes not. In that instance, negatively geared, and there are tax benefits that come as a result of that. But it's down the bottom here. But as I said, it's really important to speak to your accountant. As a mortgage broker, I can't give any financial advice, but it's important to go and speak to somebody about that, and asset diversification as well. So just helping create that diversity within your portfolio. So what is equity? And this is a question I get asked a lot. It's basically just the difference between the value of your current property and your loan amount. So for example, if your house is worth $1 million and your loan amount is worth 200,000, then you have 800,000 in equity. So you can use that to help buy an investment property. So some people don't sort of see that we can look at using that as opposed to keeping them as two very standalone investments. So on the next page, I need to talk about usable equity or accessible equity. So I spoke before and said, yep, there's 800,000 in equity. However, the accessible equity is actually because when you borrow money to purchase a property, there's what's called loan to value ratio, or LVR for short, where the bank, anytime that you borrow under 80% loan to value ratio, the bank sees it as less risky. Anytime you go over that, often you're having to pay lender's mortgage insurance, which is an insurance that doesn't actually help you. You pay for it, but it helps the bank, you know, reduce that risk, I suppose, that if there was to be a default, then they have the opportunity that they've got the insurance to help cover that. So what we're looking at on a $1 million property value, so a loan balance of 200,000, is that accessible equity is $600,000. So that's sitting there, that if you were to take that out, you still are within and under that 80% loan to value ratio, which is really important. Some lenders go up above that, but as I said, that's when you're sort of paying the additional lender's mortgage insurance. Some lenders actually now go up to 85% with no lender's mortgage insurance, but you are paying a higher rate. So what you can do then is take that $600,000 and use that to buy the investment property. Now, it can be done in a couple of different ways. One way is to actually refinance and take that 600,000 or whatever amount, but you've got up to 600,000, physically take it out as cash out and set it potentially in an offset account until you're ready to purchase a property. Then what that does is that keeps the two properties separate. Because the other way is if you didn't actually physically take that out and just use the equity on paper as such, well, that's not really on paper, but then that cross collateralizes the two properties, which means that they're tied together. So even though you would have two separate loans, they are tied. And if you wanted to refinance one and go to a different bank, you can't because they are crossed essentially. So one way that I find my customers really like is if we refinance, and obviously you need to be able to service the loan at that higher amount of 800,000 if you were going to take out the full 600,000, so 600,000 plus 200,000. You need to be able to service that, but take that out, put it in the offset account, and then you've got that money available to be purchasing an investment property, including your stamp duty and all of the costs involved there. So that's sort of the difference, I suppose, between crossing them and not crossing them. So using your equity is a great way to grow your portfolio, but it's really important just to make sure that you have looked at your finances and that you can afford the higher repayments. So often an investment loan will come at a higher rate, but also if the rent doesn't quite cover your mortgage repayments, you need to be able to cover that difference. Obviously, there's can be tax benefits when it comes to doing your tax return, but you need to be able to support that during the year. And just it's good to look at your investment strategy vision. So taking a step back and working with your support team of professionals to understand exactly what you want to achieve and how and when would purchasing an investment property fit and work for you. And as I said earlier, there are property market fluctuations, which is why ideally you would be looking at as a long-term strategies where you do get to see that sort of upward trend like that. And as we spoke about before, additional costs like lender's mortgage insurance potentially if you're borrowing up and over that 80% loan to value ratio. So getting a pre-approval is the first step. So it's going to a bank or mortgage broker to understand your maximum borrowing capacity. So how much of the equity available in your owner-occupied property or even another investment property can you actually use because obviously we need to look at whether you can service that increased loan amount. So it's really understanding your numbers, going and having a look, and also seeing whether you can support the extra costs, stamp duty, legal fees, getting a valuation on your current home so that we understand what and how much equity that we're playing with. And so we work with a bank to do that. So we get a professional valuation done. And then it's about comparing all the different loan products. And as a mortgage broker, as I said, we have access to over 50 different lenders. So finding, it's not always just about the rate. Sometimes it's finding a lender that has a product that suits you more than another one. Could be different loan terms. Some loan terms can be pushed out to 35 years, some that offer offset potentially, and not just redraw. So it's ensuring that really that the loan product and lender that's decided really does suit your needs. And then it's about getting the pre-approval so that you can go into that market with more confidence and also be seen, from the real estate agent and buyers advocates that are working with you you're seen as that your offer is strong because you actually already have that pre-approval secured. It just provides many benefits, and also it helps you work within your budget, so you're not out there looking at properties that are too expensive for your budget essentially, so you don't want to be disappointed when you start that research. There's also lots of different securities that are restricted from the lenders. So small apartments, like we get a lot now of these really small apartments, 1 bedroom, 1 bathroom, and it sort of needs, as a rule of thumb, try and look for something with greater than 50 square meters of internal living space. High density apartments, like a lot of, there's my timer. High density apartments and postcodes, serviced apartments and student accommodation are harder to borrow for. Any with combustible cladding on the outside of the property, the banks are not keen to lend for because it increases the risk. We need services to be connected, especially in those remote rural properties. Commercial property is completely separate from the residential lending space, and the property needs to be inhabitable. So I can send you a copy of this presentation if you want, but obviously my time is up. But there's just preparation for helping ensure a successful loan approval outcome. It's just 6 here. And then this slide is just saying, giving my details, I suppose, and as a mortgage broker, here to help you every step of the way. And then on the last page is just I wrote a book that it's called Why You Should Date Your Bank and Not Marry Them. So it's basically a guide to understanding the mortgage world and improving financial confidence. My mission to help ensure that supporting improving women's financial literacy. That's one of the ways that I help with that. So what I've done here is a wee QR code, and if you scan that, then I can send you a free copy of the book, because it's my goal is not to sell it, it's to give away 1,000 copies a year, just to get it into as many hands of women as possible.
That's fabulous. Thanks, Cara. And I might pop that link. If you've got a URL or something, we can pop it under the YouTube thing as well for others as well, or they can just scan it, as you've said. So thank you so much.